Have you ever felt like the economy is just uh, moving at warp speed? New headlines every day that seem to shift the ground right under our feet.
Oh,
From
absolutely.
the incredible demands of AI to, well, the complex dance of global trade
Mm-hmm.
and what it all means for your wallet.
Mm.
It really is a lot to keep up with.
It definitely is. And, that's really our mission today. We're diving deep into the major forces shaping our world, like right now.
Right.
We've pulled together a whole stack of diverse sources, trying to give you a shortcut, really, to understanding the biggest shifts
Yeah.
across tech, finance, industry, even our daily lives.
Exactly. So we're here to unpack those crucial nuggets of knowledge, explore what's really behind the headlines, and hopefully reveal what all these interconnected changes actually mean for you.
Mm-hmm.
Okay, so our first deep dive today,
Mm-hmm.
it pulls back the curtain on something quiet but absolutely colossal. It's the demand at the heart of the AI revolution.
Electricity.
Yeah, electricity. The sheer amount of power needed to fuel this whole technological leap isn't just significant. Some are calling it, frankly, insane.
Insane.
Yeah, and it's already reshaping energy landscapes, right across the country.
Okay, unpack that a bit. How much are we talking?
Well, it's an astronomical demand. There's a 2024 U.S. Department of Energy report. It found that data centers, the backbone of AI, they already consume over 4% of U.S. electricity.
4%. Okay.
But here's the kicker. That's projected to reach 12% by 2028.
12%.
We're
Wow.
talking 580 billion kilowatt hours.
Okay.
To put that in perspective, that's nearly 20 times the annual power consumption of, like, the entire city of Chicago.
20 times Chicago. Those are truly eye-opening figures. But with that kind of massive demand, is our grid, is our existing power infrastructure actually ready for that? Without huge overhauls or reliability issues.
That's the million-dollar question, isn't it?
Yeah.
Rachel Peterson, she's the VP of Data Centers for Meta. She put it pretty plainly. She said, data centers run 24/7. We use a lot of power. We need to make sure we have a robust grid.
A robust grid. Makes
Yeah.
sense. And Tom Stringer from Grassy Advisors, he noted that adequate power is perhaps the single biggest component for site selection when companies are looking to build these things.
Right, so location, location, location.
Yeah.
But powered by reliable electricity.
Exactly. So the critical question becomes, which states are actually best positioned to meet this incredible demand?
Okay.
Well, CNBC does this annual study, America's Top States for Business. They evaluate power grids on reliability, like how long outages last, and also retail price. And we're seeing some really fascinating patterns emerge.
Patterns, like what?
Well, we're seeing this clear trend. States that have both low-cost power and really reliable grids, they're becoming the new frontier for all this data center investment.
Ah, okay. So give us an example.
Take North Dakota. They actually offered the cheapest electricity in the entire nation.
The cheapest. Why is that?
It's mostly down to abundant coal and natural gas, plus, a relatively small population.
Yeah.
But they also boast significant wind power, about 35% from renewables.
Interesting. So it's a mix.
It illustrates this tension, doesn't it, in the AI energy race? While renewables are definitely growing, that foundational low-cost power, sort of regardless of the source, is still a major draw for these huge data centers.
Right. Reliability and cost are king.
Absolutely. Then you look at Nebraska. It stands out because it has America's most reliable power grid.
Most reliable.
Yep. And among the lowest costs, too. It's got this unique public ownership model for all its electricity providers.
Interesting model.
And South Dakota's another one, heavily reliant on renewables, especially wind. That's like 55% of their electricity generation. And that contributes to its really reliable grid.
So these factors, reliability, cost, sometimes renewables, that's why we're seeing these huge projects.
Precisely. Like Google's massive $25 billion investment in data centers along the largest multi-state grid covering 13 states.
25 billion.
And CoreWeave's $6 billion AI data center going up in Pennsylvania, the investment is just pouring in.
And this huge demand, it must be spurring massive infrastructure investment beyond just the data centers themselves, right? Like in the things that power them.
Oh, definitely. GE Vernova, for instance, they're pouring an additional $80 million into their Pennsylvania factory. That's in Charleroi.
Right.
Creating 250 jobs just for high-voltage switchgear, essential stuff for these grids. And that's on top of, $680 million total in U.S. investment since January alone, creating about 1,750 jobs overall.
Wow, that's serious domestic investment.
And it's not just building new stuff, it's also about transforming existing infrastructure. GE Vernova is also providing 7 natural gas turbines for Pennsylvania's Homer City Energy Campus.
Homer City. Wasn't that a coal plant?
Exactly. They're converting a former coal plant into this huge 3,200-acre data center campus, the AIM, 4.5 gigawatts of electricity by 2027.
4.5 gigawatts. Incredible transformation.
And it's not just GE. Rolls-Royce is also expanding its South Carolina plan, a $75 million investment, 60 new jobs, specifically to boost production of their M2 Series 4,000 diesel engines.
Diesel engines.
For backup power.
Exactly. For data center backup power systems. It shows this deep commitment, really, to strengthening the whole U.S. industrial base to support this AI boom.
Okay, but the story of AI's power, it goes beyond just electricity, right? It extends to the very heart of the chip.
The chips, yeah.
And there's this fascinating, almost geopolitical chess game going on, especially with China. What's the latest, maybe most surprising development there?
Well, what's really remarkable here is a pretty significant shift, it seems, in U.S. policy. But first, on the innovation side, you've got Mira Murati, the former OpenAI CTO.
Yeah.
She just launched her own startup, Thinking Machines Lab, raised an astounding $2 billion.
$2 billion? From who?
Big names.
Yeah.
Andreessen Horowitz, NVIDIA, AMD, they're building multimodal AI, apparently with an open source component too, aiming to integrate AI more naturally, with how people interact with the world.
Interesting. Okay, and speaking of NVIDIA, that brings us back to the China situation. What's the twist? Right. So Commerce Secretary Howard Lutnick recently stated that the Trump administration reversed course. They're allowing NVIDIA to resume selling its H20 chips to China.
Really? After all the restrictions, what's the thinking there?
Well, the stated reasoning is interesting. It's that China is only getting NVIDIA's 4th best AI chip.
4th best.
Yeah. And the strategy, according to Lutnick, is to, quote, keep China using it and essentially get addicted to the American technology stack.
Huh. Keep them in the ecosystem. Even with older tech, that's a strategy. And the market reaction.
NVIDIA stock jumped 4% on that news, hit an all-time intraday high, actually, nearing a $4.16 trillion market cap.
Trillion. Just staggering.
But it's not just about the chips in isolation. This pulls back the curtain on a deeper, sort of interconnected strategic play.
How so?
Well, these renewed NVIDIA sales, they were apparently intricately linked to a critical deal involving rare earth magnets.
Rare earths. Oh, okay. Connect the dots for us.
So Apple committed $500 million, $500 million to buy American-made rare earth magnets.
American-made. From where?
From MP Materials' Texas facility, and Apple is actually helping to build that facility out.
Okay, so private sector investment.
But here's the big move. The Pentagon also agreed to buy a direct equity stake in MP Materials.
The Pentagon. Buying stock in a mining company.
Exactly, making the U.S. government the miner's largest shareholder. It's a very clear strategic move to counter China's dominance in rare earths.
Because China supplies most of them now.
Something like 70% of U.S. rare earth imports in 2023 came from China. And these materials, they're absolutely crucial for military tech like F-35s, drones, but also for the magnets in, your phone or computer.
So the NVIDIA chip decision, the rare earths investment, it's all part of a bigger picture about supply chains and national security.
It certainly looks that way, a very complex interplay.
Okay, let's shift gears a bit. Moving on to navigating these broader economic headwinds. Let's talk inflation, always on everyone's mind. What do the latest numbers tell us?
Right, the June 2025 CPI, the Consumer Price Index, it rose 2.7% annually. That's up from 2.4% in May.
Okay, so a slight acceleration annually. What about monthly?
The monthly increase was 0.3%. That's actually the biggest jump we've seen since January.
And core inflation, the number that strips out food and energy.
Core was up 2.9% annually and 0.2% monthly. So a bit more moderate on the monthly core reading.
What about the details? What's driving it?
Well, it's kind of a mixed bag, really. Gasoline prices were slightly up month over month, but they're still down quite a bit, 8.3% compared to last year.
Okay. Groceries.
Groceries rose 0.3% in the month, up 2.4% annually. Meats, poultry, fish, and eggs saw a pretty noticeable annual increase, 5.6%.
Ouch. And housing. That's always a big one.
Housing, yeah, the largest component of the CPI. It was up 0.2% monthly, 3.8% annually, so still elevated, but the monthly increase was a bit softer.
Anything go down?
Yeah, actually. Used cars and trucks and airline fares both declined in June.
Okay, expert, these numbers. They seem, well, mixed, as you said. But when we layer the whole tariff debate onto this picture, Do you see a clear direction? Is one side of that argument, tariffs cause inflation versus tariffs boost domestic buying, holding more weight right now?
That is the critical tension, isn't it? You've got the White House, through economic advisor Kevin Hassett, suggesting consumers are simply shifting to American goods, and so tariffs haven't been as inflationary as maybe some expected.
Right.
But the data we're seeing from businesses like Albertsons reporting rising costs, and warnings from economists like Mark Zandi at Moody's, they strongly suggest the inflationary impact of tariffs is not only real, but it's likely still building.
Zandi warned about inflation kicking into higher gear.
He did. He specifically warned that inflation is going to kick into a much higher gear. And you have Susan Morris, the CEO of Albertsons, saying she's already seeing cost increases for ingredients and packaging, and acknowledging some of that could get passed on to consumers.
So the view from trade analysts seems pretty blunt then.
Yeah, quite stark. One perspective is the damage is coming and coming faster than some people would like to admit or acknowledge. There are also real concerns about unintended consequences, especially for allies like Japan.
And we're hearing about more potential tariffs.
Yes, President Trump recently threatened 30% tariffs on the EU and Mexico, potentially starting August 1st. And also these secondary tariffs, maybe around 100% on Russia's trade partners.
100%? Wow.
Yet, amidst all these threats, new trade deals are also emerging, which just adds another layer of complexity.
Like the Indonesia deal.
Exactly. Trump announced a preliminary deal there. It includes a 19% tariff on Indonesian goods coming into the U.S., but in return, Indonesia commits to buying $15 billion in U.S. energy,
$15 billion.
$4.5 billion in American farm products, and 50 Boeing jets. And Commerce Secretary Lutnick indicated Indonesia would drop its own tariffs on U.S. goods. There was a similar deal structure with Vietnam recently, too.
So it's tariffs on one hand, specific deals on the other. A very dynamic, maybe even unpredictable trade landscape.
Definitely multifaceted.
Okay, this complex economic picture, inflation, tariffs, trade deals, it naturally brings us to the Federal Reserve.
Yeah.
What's their stance on interest rates amidst all this?
Well, the bond market certainly sent a signal after that June CPI report. The 30-year Treasury yield rose above 5%.
Above 5%, that's high.
It's the highest level since May, yeah. It definitely signals persistent inflation concerns in the market.
And what does this mean for Fed rate cuts? Any chance this month?
The market seems to think not. The June CPI report basically solidified expectations. There's now something like a 97.4% probability priced in that the Fed will not cut interest rates this month.
Almost certain they hold steady.
And Fed Chair Jerome Powell himself, he sort of indicated that the central bank likely would have cut rates earlier this year, if not for all the uncertainty created by the Trump administration's tariff policies.
So the tariffs are directly impacting Fed decisions, or at least Powell suggests they are.
It highlights the unique challenge the Fed faces, navigating economic data in such a politically charged environment.
And that political pressure is undeniable, isn't it?
Oh, absolutely. President Trump has publicly called for a 3-point rate cut, claiming very low inflation and saying it would lead to $1 trillion in annual savings.
He also had some choice words for Powell.
Yes, he's called Powell a knucklehead in the past, and recently stated he has proof for his case with the latest CPI data.
But is Powell's job actually on the line?
Well, Treasury Secretary Scott Bessent clarified recently that Trump is not looking to fire Chair Powell. However, he did say the formal process to find a replacement has begun, as Powell's term ends eventually anyway.
So, not firing him now, but the search for his successor is underway. It's certainly a tense dance between economic policy and political rhetoric.
Very much so.
Okay, let's pivot a bit now. Let's shift gears to some really fascinating business innovations and market shifts, starting with the crypto market. It's been making some serious headlines again.
Yeah, Bitcoin recently shot up, hit a new record above $123,000.
$123,000.
It pulled back a bit, hovering around $116,000 maybe, but still. That's nearly double its level from just a year ago.
What's driving this run? Is it like the past cycles driven by retail investors?
Well, what seems remarkable this time is that it isn't primarily driven by that kind of retail mania. It seems more fundamentally powered by structural demand, macro positioning by larger players, and significant Wall Street adoption.
Wall Street adoption, like the ETFs.
Exactly. The spot Bitcoin ETFs are just pulling in massive inflows. $2.7 billion in 1 week recently.
$2.7 billion.
And look at BlackRock's iShares Bitcoin Trust. It now holds nearly $90 billion in assets. That puts it among the top 20 ETFs in the entire U.S. market.
90 billion. Incredible.
And the total assets managed by all the U.S.-listed spot Bitcoin ETFs, it's over $153 billion now, up from zero just 18 months ago.
That's a staggering amount of capital flowing in. Who's allocating?
We're seeing financial advisors, sovereign wealth funds, even corporate treasuries allocating at a record pace. Public company holdings of Bitcoin are reportedly up 23% to $91 billion.
Companies holding Bitcoin on their balance sheets.
Yeah, firms like GameStop and Trump Media reportedly planning a $2.5 billion purchase. They seem to be treating Bitcoin almost like a strategic reserve asset.
Huh. So it's becoming institutionalized.
It seems to be moving in that direction. Plus, you had some technical factors like June options expiry and a bit of a short squeeze contributing to the recent run-up. And interestingly, Bitcoin seems to have reestablished its correlation with the Nasdaq.
So tech stocks and Bitcoin moving together again. Paints a picture of a maturing market, perhaps.
That's certainly one interpretation.
And a really critical aspect here has to be the intersection of these market forces with policy and regulation, right?
Absolutely crucial. And we saw a positive sign there recently. The Department of Labor cleared 401k plans to offer Bitcoin ETFs.
So Bitcoin in your retirement account.
Potentially, yes. It opens up retirement savings for crypto allocations, which is a pretty significant step towards, mainstream acceptance.
Okay. But it wasn't all good news on the policy front, was it? What happened during Crypto Week in the House?
Right. That was a major blow, actually, for the industry. Several Trump-backed crypto bills, they failed a key procedural vote in the House.
Which bills were those?
Included the Genius Act for stablecoins and, critically, the Clarity Act. That one was about defining SEC and CFTC jurisdiction over crypto.
And they failed. Why?
The vote was 196 to 223 against moving forward, and notably, 13 Republicans voted against the measures, despite the Trump backing.
What would the Clarity Act have done specifically?
Well, it aimed to provide, legal clarity. It would have given the CFTC, the Commodity Futures Trading Commission, jurisdiction over digital commodities like Bitcoin and Ether. It also outlined a path for broker-dealers to handle crypto, which could have really opened the doors for more institutional involvement in decentralized finance, or DeFi.
So a setback for institutional adoption, potentially. How do crypto stocks react?
Unsurprisingly, yeah, crypto-linked stocks like Circle, Coinbase, Mara Holdings, they all turned lower after that vote.
But the industry isn't just taking this lying down, right? What about the lobbying efforts?
No, definitely not. The crypto super PAC, Fairshake, they announced a $141 million war chest.
Oh, $141 million.
Yeah. They raised $52 million just in the first half of 2025 alone, including a hefty $25 million chunk from Coinbase. Their spokesperson said they're building an aggressive, targeted strategy for next year to make sure pro-crypto voices get heard loud and clear in Washington.
So the political battle continues. It's also interesting to see how traditional finance is kind of grappling with this space.
Yeah.
What's the latest from the big banks?
Well, you have Jamie Dimon, the CEO of JPMorgan Chase. He's famously said he doesn't really get the appeal of stablecoins.
Right, he's been skeptical.
But even he acknowledges his bank will be involved, both with their own JPMorgan deposit coin and with other stablecoins. Why? He recognizes the need to compete with fintech.
Interesting. So even if he doesn't get it, he sees the business reality.
Seems that way. And it's not just JPMorgan, Citigroup, Bank of America.
Yeah.
They're also reportedly exploring stablecoin issuance.
So while Jamie Dimon might not personally get stablecoins, his banks move. It really signals these digital currencies are moving from maybe a niche tech thing to becoming part of mainstream finance.
It really does. It could impact how you manage your money, maybe even how you get paid someday.
Okay, beyond finance, we're seeing some pretty significant shifts across other industries too. Especially in transportation, it feels like the move away from traditional models is really picking up speed.
Absolutely. And it's not always in the direction you might expect.
How so?
Well, take the auto industry. GM General Motors, they're actually expanding production of gas-powered SUVs and trucks.
Gas-powered? Really, which ones?
Things like the Cadillac Escalade, the Chevy Silverado, the GMC Sierra. They're moving some production from Texas to Michigan, adding capacity in Indiana too.
Huh. But didn't GM set a goal to go all electric?
They did, back in 2021. They aimed to exclusively offer EVs by 2035. But this move, it builds on a $4 billion investment in U.S. facilities, sure, but it clearly reflects a shift. They're adapting to slower than expected customer demand for EVs right now.
So, automakers responding to the market signals in real time. Makes sense.
Then you have the emerging air taxi market. That seems to be truly taking off, pardon the pun.
Air taxis, like flying cars.
Sort of, yeah. Electric vertical takeoff and landing aircraft EV tolls. Joby Aviation is a big player here. They just doubled production capacity at their California facility. They can make 24 aircraft a year now.
Okay.
And they're starting component production in Ohio. Their goal is to actually roll out air taxi service in 2026.
2026, that's soon. Are they flying anywhere yet?
They've already delivered their first EV toll to the UAE, the United Arab Emirates, for service starting next year. And Toyota engineers are helping them ramp up the Ohio production, aiming for 500 aircraft annually eventually.
500 a year. And there's government support, too.
Yes, this is all happening just as President Trump signed an executive order for an air taxi testing program. And Joby's stock, it's up 70% this year alone.
Well, it really feels like a new industry gaining serious momentum very quickly.
It's remarkable to watch.
And beyond just transportation, what other interesting shifts are catching your eye?
Well, in space launch, Rocket Lab's stock recently hit an all-time high. That was boosted by Citi raising their price target. So continued excitement in commercial space.
Okay.
And the pet care industry is evolving too. Chewy, the online retailer, their expansion into actual veterinary clinics and their pharmacy segment, that seems poised to benefit.
Why now?
Well, think about all the pets adopted during the pandemic and are getting older now, needing more vet care. Plus, overall pet adoptions are apparently rebounding.
The pandemic puppy effect, plus a broader trend. Got it. What about retail? We mentioned Albertsons seeing tariff impacts. Any other big retail stories?
Yeah, the story with Target is pretty striking. Their stock has plummeted down 61% since late 2021.
61%?
Yeah.
Why such a drop?
Well, annual sales have basically stagnated for 4 years, and they're actually expected to fall this year. Customers are reporting issues, out-of-stock items, staff seeming less friendly, stores looking messy, and the merchandise feeling like a sea of generic items.
Oof. What does Target say?
The company points to a few things. Weaker discretionary spending by consumers, the uncertainty around tariffs, but also, interestingly, backlash related to its DEI rollbacks.
DEI, diversity, equity, and inclusion.
Exactly. They rolled back some initiatives, and apparently, former employees have noted a decline in corporate culture and morale since those cuts.
So it's a mix of economic pressures and internal cultural shifts.
It seems like it. That famous Target cheap chic identity seems to be fading. Fewer exciting brand collaborations, more focus on private labels, likely for profit margin reasons.
And the DEI rollback had external consequences, too.
Apparently so. Twin Cities Pride, for example, cut ties with Target because of it. And reports suggest store traffic actually declined after the DEI announcement was made, except for a bump around Easter.
Wow. It's a really powerful illustration, isn't it? How these broad economic forces, consumer sentiment, and corporate decisions, including cultural ones, can really impact even the biggest retail players.
Absolutely. It all connects.
Okay, let's try and bring some of this back down to earth, back to you, the listener. Let's talk housing affordability and maybe some lifestyle choices. The median U.S. household income. It's just over $80,000 right now.
Right. And if you use the standard HUD 30% rule, that's the Department of Housing and Urban Development guideline on your gross monthly income.
Meaning, don't spend more than 30% of your income on housing.
Exactly. For an $80,000 income, that means a household probably shouldn't be spending more than about $2,000 per month total on housing.
And that $2,000 isn't just the mortgage payment, right?
No, absolutely not. That has to cover everything. Utilities, which average around $380 a month nationally. Property taxes, they vary wildly. It could be anywhere from, say, 0.26% to 1.83% or more of your home's value each year.
Okay.
And homeowners insurance. The average was about $275 a month in 2024. Plus, if you put less than 20% down on your mortgage, you've got PMI private mortgage insurance tacked on as well.
Right, that extra cost that protects the lender. So when you add all that up, that $2,000 budget gets eaten up pretty quickly. What kind of mortgage payment does that leave for someone earning $80,000?
Realistically, it means you could comfortably afford a principal and interest payment of maybe $1,200 to $1,500 per month.
Okay, $1,200 to $1,500. And what kind of house price does that translate to, roughly?
Well, assuming you have a 20% down payment and you get a 30-year fixed-rate mortgage at, say, 6.5% interest, that affordability range means you could probably afford a home price just under $300,000.
Under $300,000?
Yeah.
Which, depending on where you live in the country, might be challenging.
Very challenging in many markets. And there's another growing challenge here. Homeowners insurance costs. They're rising so much, so fast in some areas.
How much?
Well, we're hearing stories like one homeowner whose premiums jumped from $7,000 a year to $12,000 in a single year.
$12,000 a year just for insurance. That's $1,000 a month.
Exactly. It's easy to get lost in these big economic numbers, but when you hear stories like that, it really brings home how these macro forces, climate change, impacting insurance risk, inflation, translate into real, sometimes unbearable financial stress for individuals.
And this must be contributing to affordability issues overall.
For sure. It's actually contributing to rising mortgage delinquencies, especially among more vulnerable groups like first-time homebuyers who might be stretching their budgets already.
It's a tough environment,
Yeah.
which maybe leads people to think about alternatives. On a perhaps slightly lighter note, have you ever considered retiring on a cruise ship?
Retiring? On a cruise ship? Like permanently?
Apparently, it's a concept being explored as people look for different retirement options, maybe as a creative way to handle rising housing costs, combine living expenses with, well, a perpetual vacation.
Huh. I suppose it bundles accommodation, food, travel. It's certainly a unique option, isn't it? In a world where these economic realities are constantly shifting, maybe forcing us all to think a little more outside the box.
Definitely thinking outside the box. So when we wrap all this up, what does it all mean for you listening right now as you navigate this world? A world where, maybe a football field gets called a soccer pitch, depending on who you're talking to, and your home's power source could actually be driven by the demands of the latest AI data center down the road. Consider how quickly these new technologies like AI and shifting policy priorities like tariffs or energy investments are not just reshaping entire industries, but also the very landscape of where we live, how we work, and even the everyday costs we face at the grocery store or, for our housing.
It's incredibly interconnected.
It really is. So the question to maybe leave you with is, how will these profound shifts in energy and trade and digital assets in how we live, how will they continue to redefine what it means to be well-informed and maybe even resilient in this rapidly changing environment?